Okay. So everybody, welcome again. This is week three, session three of the Surviving High Prices webinar series. Today we are talking about risk management and also what to do with these profits that producers are getting during these high cattle prices and the current point in the cattle cycle. So we're going to talk about those two things today. With us today, our speakers are Dr. Kenny Burdine from the University of Kentucky. We have Dr. James Mitchell from the University of Arkansas, Dr. Brian Mills from Mississippi State University, and then Matthew Fischer from Clemson University. Pretty impressed that I just remembered all of that. So without further ado, we'll go ahead and I think Dr. Burdine, you're going to start us off with talking about risk management. If anybody has any questions throughout the presentation, feel free to throw them in the chat. And then we'll also have time at the end and in between presentations for you to unmute and ask questions. So, Dr. Burdine, I'll go ahead and let you take it over.
All right, sounds good. If you have any trouble, Hannah, just stop me and let me know, but I'll roll on. So good to be on. So those of you that don't know me, Kenny Burdine, University of Kentucky. I've been in UK AgriCon. I'm in my 26th year. My partner, James Mitchell, he and I work together on a lot of this risk management stuff, particularly LRP, and he's also on to be part of the discussion. I'm going to give the presentation though here today, and I'm not going to waste a lot of time. I'm going to jump into it due to time. So we're going to talk about livestock risk protection insurance, and I was pretty excited when this first came available in our area because it was the first tool that we really had access to that made sense for smaller operators. So kind of a quick overview, it's a subsidized insurance product that's designed to protect against decreasing cattle prices. It's a classic index insurance product. You're not insuring the value of your cattle. What you're really doing is you're guaranteeing, value based on the CME feeder cattle index. If any of you have been, to a program, and I've probably done 150, well, 100 or so of these over my career. There's kind of futures and options oriented. It's very similar to a put option in the way that it works. You kind of can establish a price floor. LRP has been made much more attractive recently. Subsidies were increased 4 years ago. They also changed it where you could actually pay your premium after the ending date. So both of those two things and a few others have made it much more attractive. So uptake has really taken off in terms of use of LRP insurance. The index that's used is the CME feeder cattle index. It's a 7-day weighted average of feeder cattle prices in 12 states. And bottom line is it's all the steers that run between 700 and 900 pounds and don't have a designation of some type. You can see on the left there the 12 states that are included. There's a wide range of geographical representation here. A lot of us on the call today or on the webinar today are outside of those 12 states, so we know that our cattle tend to sell for a bit less than they do in those 12 states. Some of you are right in the heart of that, and you may even see your prices run very similar. But I just make the point you do want to kind of think about how your cattle values tend to compare to the futures market, or in this case, the value of cattle there in those 12 states, because that does matter in terms of understanding what's being offered through LRP. I'm not going to spend a lot of time on the right side of this. Just I want to make the point that I'm going to keep things simple and high level in my 25 minutes today, and I'm going to focus on an application just with heavy feeder steers. But you can cover calves, heifers, dairy cattle, Brahman cattle, unborn calves. There's lots of things that can be done. Large operations can and do use LRP, but the thing that I like most about it is it fits for small operations. So I've always worked with a lot of folks that run, fairly small cattle operations, and LRP is the first tool we had available where someone wasn't locked into having to think in terms of 50,000 pound quantities when they try to protect the value of cattle if they were going to sell. So my last background slide, I'm going to jump into scenarios, but so you can buy LRP through a lot of different types of insurance agents. Most anyone that sells farm or crop type insurance will either offer LRP or have someone in their network that does. So I always say start with whoever you work with typically. The RMA on their website does have an agent locator tool, so you can enter a zip code or a city and search within a given radius for folks that do sell products like LRP. In terms of kind of big picture, when you buy an LRP policy, every policy has an ending date and an expected ending value. And that ending value is really the expectation of what that CME index will be on that ending date. And it's going to be very close to what the futures price is for that month. You want to choose an ending date very close to when you plan to sell those cattle. You want to choose a coverage level that makes you comfortable. And it really is pretty simple. If on that ending date, the index, that CME index, is below the coverage level that you chose, and the indemnity is due on every pound that you covered. So just kind of for simple math, if expected ending value when you bought coverage for the ending date was 240 and you bought coverage at 230, come that ending date, if that index was below 230, you would get dollar for dollar compensation on every pound that you covered. And my philosophy on this has always been people learn best when something is tied to an illustration. So that's where we're going to go right now. So I'm going to talk about just kind of a simple backgrounding scenario. And, that term gets used differently in different parts of the country. I'm here in central Kentucky. I'm actually in my office in Lexington right now. So, this would be a fairly typical program for Kentucky, but because we're in a big geographical area here, don't focus too much on the actual numbers. But I'm talking about an operation that places a 5 weight steer in some sort of feeding program in October this month. Very simple ration that nutritionists trust an economist with, a very simple one, a 3 way blend, so corn, gluten, soy hulls, valuing that at about 240 a ton right now in Kentucky, and then grass hay, about $80 a ton right now in this area, and getting 3% of their body weight of those two things. So 1.5% of the 3 way blend and 1.5% of body weight of the grass hay. And that should do about 2.5 pounds a day. Over a 120-day program, I'm going to assume that adds 300 pounds. So those 500-pound steers in October, I'm moving as 800-pound steers in February. Again, trying to stay high level, not get too far into the weeds, but the March futures, when I put this together, we're in the low 340s, as it always happens. They jumped about $4 or $5 yesterday. That never fails. But when I put this together Friday and Monday, they were around 341 or so. So I just kind of, said to keep things simple, we're going to assume that March futures are 340. We'll kind of use that as a quote unquote expected ending value. Then I've got to think about how prices in my area or your area compare. And I'm going to use something like $10 under, meaning that the cattle that I sell are going to sell for about $10 back of that CME index or back of futures. So that 340 in those 12 states probably translates to something like 330 in my area for 800-pound steers come February. That's kind of the way you want to think about what this means. Now, when I teach this at home, and my apologies to the Kentucky agents that are on there because they've seen me go through this, I'm sure, multiple times, but I like to simply tie it to an actual scenario. So I've put together a simple backgrounding budget. There's that expected sale price at 330 for the 800-pound steer. I'm assuming I can get a 5 weight steer bought for something around 420. I've got those feed costs I mentioned in there. I've got mineral cost in there, vet and medicine, sale expenses, and I can go down the line here. Bottom line is start with something like this that makes sense for you, and we're going to apply LRP to it. Now, what LRP is going to do is attempt to protect that one number that I circled. This is all about protecting that potential sale price. And in all fairness, once I place that animal into this program, there's not too many numbers on that budget that are going to impact my return or my profit or loss any more than that sale price. And LRP is all about trying to protect that sale price, in this case, that $3.30 per pound. Now, there'll be multiple potential coverage levels that can be bought. I'm just kind of simplifying the world here as we talk about this. So we're looking at an ending date in late February. I'm working off an ending value around 340. That would, as I said, be a little low if I was doing this today. But there may be three different coverage levels that I can buy. Maybe I could buy a 338. That would be really expensive. That might cost me $6 a hundredweight. Since I'm planning to sell 800-pound steers, that's $48 a head. But that's what I'd call a very low deductible insurance policy. Expected ending value is 340. My coverage level is 338. So that market just has to drop by $2 a hundred for that to be in the money and to start to pay me. So that's what I'd call a very, very low deductible, high coverage policy. Maybe I could buy a 334. That would cost me a little bit less. That might be $4 a hundredweight. On 800-pound steers, that's 32 bucks a head. But I've got to self-insure that first $6 of drop. It's got to move from 340 to 334 before I get any help. And I could even spend a little less, maybe buy something like 328. I got to self-insure $12. That's going to be a lot cheaper. And I could go through a bunch of examples here. Bottom line is you're going to choose a coverage level and a premium you're comfortable with, and you're going to roll with it. So the assumption I'm going to make is that I buy that middle one. I buy that 334 coverage level. I'm locked in at a premium of $4 a hundredweight. I'm going to spend $32 per head on LRP coverage. And when I like to think about this, I like to drop that right into that budget. So this is the exact budget I showed you earlier. The only thing I've done, you can see the yellow there. I've now dropped that premium cost into that budget, and I'm going to treat that like a cost of production. And the truth is, I'm going to make $32 less per head because I spent $32 on insurance. And now we're going to talk about how that might benefit me down the road. So we're going to sell this steer. We're going to sell this steer 3 times. And the first one's going to be in a strong market. So that LRP value that I thought was going to be 340 come February ends up being 360. So the market, in other words, ends up going up $20 a hundredweight. It's $20 a hundredweight higher than I expected. If that's the case, I probably sell my cattle also for more than I expected. So those steers I thought would sell for 330 a pound actually sell for 350 a pound. I'm still out $32 because I bought the insurance. But this is really best case scenario. And this is one of the more common calls that I got really starting about middle of summer in 2025 through now. A lot of folks bought LRP back in the spring and then saw the market take off. And that's a good problem to have, right? But they were calling me saying, okay, is there anything I can do to protect, the profit that I've got now this market's moved up? So for clarity, here's that same budget. You'll still see the insurance in there at 32 bucks a head. But notice I've added that new sale price in there, which is 20 cents higher. So profit is going to be $160 higher in this scenario because I've got 20 cents higher price on an 800-pound steer. Again, I'm still out $32 a head on insurance that I didn't need. But the beauty of this is I got the benefit of that rising market. With the exception of 32 bucks, I got the benefit from that market being stronger. I didn't lock in a price. I just had coverage there if I needed it. So that's scenario number one. Prices rise significantly. There's a scenario here I'll talk about just very briefly, but occasionally prices just fall a little bit. So again, we had bought coverage at 334. What if the ending value drops just a little bit, goes to 336? It's less than we expected in the beginning, but it's also not low enough to trigger an indemnity of any type. So if that's the case, I do sell my steers on a little bit lower market. And I'm still out 32 bucks in insurance. The market fell, but not enough to trigger an indemnity. So this would look something like this. I've got my premium cost in there. I sell the cattle for basically, in this case, 4 cents a pound less than I expected to when I placed them in October. I get no help with the insurance. So I like to describe this. This is kind of like having a $1,000 deductible on a vehicle and then having a little $600 fender bender. It's kind of the same idea. I had coverage. The market just didn't fall enough that my insurance paid me any benefit. And then the one that I think is the one most important one to understand is what if this market drops significantly? So what if that ending value that was expected to be 340 ends up being 320? Another way to say that is, what if that market is $20 a hundredweight or 20 cents a pound lower than expected come February when I sell those cattle? If that's the case, those steers that I thought would sell for 330 probably end up selling for something like 310. I'm still out $32 a head on the insurance. I will be every single time. But now I'm doing indemnity. I bought coverage at 334. LRP ending value actually ended up being 320. That's a $14 a hundredweight difference, or 14 cents a pound on an 800-pound steer. That's worth 112 bucks a head. So when I drop that back into the budget, what we're going to see is that the insurance paid out, I'm going to get an indemnity, but I'm also going to hit what ultimately was my price floor. So that one looks like this. You can see the lower sale price for that feeder steer at $3.10. You can see the payment here, the indemnity, and the amount of $112 per head. Again, I'm still out $32. But the beauty of this is what I want you to understand is because I had the insurance, that return in this case didn't go negative. In fact, it stayed north of 75 bucks a head, which to me is something that I would find fairly attractive if I were in this producer's shoes. I'm going to show you the exact same thing now without LRP, just for comparison purposes. If I sold those same cattle on that same, weaker market, 20 cents lower, I would not have had the indemnity. In fairness, I also would not have had the premium cost. So both of those are zeroed out, and I would have essentially broke even or lost $2 a head. And I think it's important to kind of look at these side by side to understand what LRP did for me in a market like this that actually dropped about 20 cents a pound from, in my example, from October to February. The last point I want to make here is that 20 cents a pound or 20 weight is not by any means worst case scenario, right? That's what I chose for illustration. I could have done this for a $30 drop, a $40 drop, a $50 drop. So obviously this, that negative $2, that $2 loss could look a whole lot worse if the market dropped more than the assumption that I made here. A couple of things here as I kind of think about trying to wrap up and then answer any questions and listen to Matt and Brian. But this is that baseline scenario. So what I'm showing you there right now with an ending value expectation of 340, $10 basis, I expect to sell my cattle for 330, premium of $4 a hundredweight. Expected return per head was about $126 per head. As that sale price drops, so as the CME index drops and as my local cash price drops with it, I hit that price floor and notice how my return per head flattens out there at that $78. And again, that's assuming that I was accurate on my basis estimate. Point that I want to make though is no matter how bad the market gets, that does kick in and give me some coverage. Again, the other beauty of LRP, in addition to having a floor in place where I can kind of stop the bleeding or at least cover my cost, I also get the benefit when the market goes up. So each increase in market price between placement and when I sell those cattle, I get the benefit of it. So there's almost unlimited upside if the market continues to increase. So one of the nice things about LRP, and same thing with put option, is I've got a price floor in place. Of course, I pay a premium for that, but I also don't set a ceiling on the value of my cattle either. If you're more of a visual type person, sometimes this is a good way to kind of think about it. If I have no price protection, and if the y-axis there is my return per head and x-axis the overall market, this is pretty simple. If the overall market is really good, my return's really good. If the overall market stinks, my return stinks. That's pretty simple. If I was just kind of look at an expectation from the beginning with no insurance, the very first budget I showed you expected return of $158 a head. So that would kind of be my expectation. So maybe I could forward contract cattle for that, maybe not. But LRP looks kind of like this in the sense that I do, in fact, have a floor in place. You can kind of see going from left to right there where the floor is. And then once prices start to improve, then I get to benefit from that. So the difference in no protection and LRP and a strong market is just the premium difference. In our case, it was at $32 a head. And the difference in that expectation in the beginning with that LRP, and then my floor would be two things. One being the premium, obviously, and then the second being that deductible, meaning how far away from the expected ending value the coverage level that I chose was. So I'm going to end with just a few thoughts here. I wanted to keep this fairly simple given, the fairly short amount of time, although we can answer questions by all means. But I do want to make the point that this can also apply for cow-calf operators that are moving lighter calves. The break on LRP is a very hard 600 pounds. So you can cover cattle at 600 pounds to 1,000 pounds and cover cattle 600 pounds and under. But if you're covering calves under 600 pounds, there's a little bit of adjustment that occurs. For steers, you expect to sell under 600 pounds. What they do is they essentially tack 10% onto that index to kind of account for the fact that those steers should weigh more. Those lighter heifers are going to be valued right at the index. That's kind of how they account for the fact that A, lighter steers tend to sell for a higher price per pound, and then B, obviously the heifers tend to sell for less than steers. Something that just became available 2 years ago, I think it was, is that calves can be covered now before they're born. I don't know a lot of folks doing that, but a lot of folks did want that option, so that is out there now. So you can really cover cattle pretty far out now if you want to. So that's on the table and possible. Second to last thought here as I kind of go through this, I always like to make this point that folks ask all the time, well, what if I can't sell the cattle when I plan to? It's okay. Um, the way that it's written, you can sell the cattle as much as 60 days before the ending date. Now, if I do that, I run the risk of selling the cattle 60 days early, and then the market rallying after that and me not getting an indemnity because the indemnity only matters on the ending date. I will mention this back in the spring for the current reinsurance year, they did add a drought provision. So if drought worsens, and there's a mathematical way they do this, you can actually sell cattle even sooner than the 60 days. But I don't want to get in those details for this short discussion. Similarly, you can sell the cattle anytime afterwards, but just understand you're unprotected past the ending date. So, you may well sell the cattle excuse me, you may see the market move after you sell those cattle in that, or sorry, you may see the market move after the ending date. Bottom line is the only date that matters for identification purposes is the ending date period. It's if you've dealt with put options at all, it's very much like buying a put option that can only be exercised at expiration. That's kind of the best way to think about it. Last thoughts, and I'll answer questions and listen to Matt and Brian. When I talk to producers about managing risk, there's several things I like to talk about, and here's just kind of four that I think are important. But number one, I really do think that sometimes it starts with just basic budget sensitivity. Put a budget together, start playing with changes in sale price, and you'll quickly understand how sensitive returns are to those changes in price. And by doing that, you can pretty quickly start to see um, how much there is to lose if the market moves downward significantly while you're feeding or grazing cattle. I tell people to treat the insurance as a production cost, and I say, and when you do that, don't look back, right? We can't manage risk looking backwards. We've got to manage risk looking forward. So I kind of use the analogy, reach up, grab the rearview mirror, and rip it off the windshield. When decisions made, move, and just treat premium as a production cost. That's kind of why I like to drop it in that budget, like I did with you a few minutes ago. I like the idea of setting pricing targets ahead of time. If we're honest with ourselves on a program like this, the day that we buy those light calves or choose not to sell those light calves that we're going to background or stocker ourselves, a whole lot of our costs are sunk that day. So I think protecting our price from day one is a good strategy. But on the same note, if you're someone that wants to be a little more opportunistic about it, that's fine. Maybe you want to kind of see what the market offers. I think that's fine. But I always say set some targets ahead. For example, if I can buy this coverage level for this price, I'm going to do it, and then put it on autopilot. Don't try to make risk management decisions in real time. Your mind will start to play tricks on you. In a rising market, you'll want to start wanting to wait and try and hit it at the perfect time. In a down market, you'll kind of hesitate and not want to move on something because you could have done better last week. So take that out and just think about setting them ahead of time and then just making it happen. And then, I mentioned this, but one of the more common calls that I've gotten the last few months has been someone that bought LRP back in the spring, going to sell cattle this fall, and the market's moved way beyond what they expected. So basically, they're saying two things: A, can I protect what I've got now? But also, did I waste 30, $40 a head on price insurance? And I understand the logic there, but I always like to leave with something kind of along these lines that if you're not leaving money on the table occasionally, if you're not spending some money on insurance occasionally that doesn't work out, then I think you're probably taking too much risk. So I think it's not necessarily a bad thing if you jump on these markets early sometimes. My contact info, just so everybody's got it. Reach out to me by email or phone anytime. I always enjoy hearing from folks. If you want to get cattle market notes weekly that James, myself, and our colleague Josh Maples, who I think may even be on today, if you want to get that, you can sign up there with that QR code or reach out to any of the three of us and we can certainly get you added. So again, many thanks, Hannah, and I will stop sharing.
Great. Thank you so much. That was a great presentation. Personally, I've learned a little bit about LRP, but I always enjoy hearing from you because you always do it on such a scenario basis and it really makes a lot of sense. For all of you that are on, I would highly recommend subscribing to their weekly newsletter. It's always really good, really helpful. Does any of our speakers have anything to add in terms of risk management, LRP, and do we have any questions? I'll go ahead and do a brief pause for those.
You want to add anything, James, by all means, feel free.
I think I'm good right now.
Okay, if not, we'll let y'all think over that and we'll go ahead and move into our next presentation with Brian and Matt. So y'all should be able to share your screen.
All right. Good afternoon, everyone. My name is Brian Mills. I'm at Mississippi State. My area is farm management. So today I'm going to talk just kind of some things that we hear on what do you do with these high profits. That's kind of be a higher level. We're not going to get too specific, but I'm going to have a couple examples of just looking at some things. So it's probably hopefully we're not getting in a situation like we're in the crop side where a lot of people did some things maybe when prices were high, and now that they might be struggling. So that's kind of what our idea is to maybe prevent some of that. You guys have probably seen this if you've been on these webinars, but this is kind of a trend of what we see in dollars per cow of what producers have made over time. You can kind of see there's these periods where you're making a lot of money, and then there's periods where they're losing money. And so the idea is in these times of high prices and high profitability, what can we do to sort of prepare ourselves for when prices go down? Because inevitably they're going to go down, right? At some point we're going to have lower prices, lower profitability, and so what do we do in those situations? And so a couple of things. Typically, what we see, all these different options. What do we do or what not to do with high prices? The big one we typically hear is, I'm going to go buy some equipment, right? And that's we're going to talk about a couple examples on that. Talk about some improving herd efficiency, what you can do to improve your herd efficiency and use that as a way to invest in your herd. Matthew's going to talk a little bit about the forage production side of things, and then I'll mention a little bit on the farm financial health. But to get into this, purchasing equipment, there's typically what we hear is, farmers they want to buy equipment so they don't have to pay taxes, right? They want to reduce their tax obligations. I'm not going to get into sort of the tax side of that, but it can be a valid option. It can reduce your taxes if you are buying equipment. But what I usually stress is that it should not be the sole reason for buying, right? If you're only buying equipment for the tax benefits, you're kind of setting yourself up for to be hurt when prices go down. And so that reason for that is these tax benefits are relatively short term, right? You can get the tax benefit for a couple of years, but you have that equipment for a really long time, right? You're typically having it for 10, 15 years, whatever it is. It's a long-term investment. You're still having to pay off that loan when those prices come down. And those tax benefits are less when those prices are low. And so you don't want to set yourself up by buying this just for the tax purposes when you're going to have this equipment over a longer period of time. So one of the things is, this new equipment can actually increase your cost of production, right? It's kind of a unique thing in ag is that if you buy equipment, you can actually increase what it costs to raise the herd or the crop, whatever it is, and which means it can increase that break-even price, right? So it means you need a higher price now to be profitable. And so when prices come down, it increases the risk that you're going to lose money, right? Because you have now a higher price needed. So it can increase those and make essentially lower prices. It can make it more risky for your operation. So it's really important to determine, if I buy this equipment, how is that going to impact my cost of production or my revenue? Really what we want to do, and what I tell producers, is they want to buy equipment that makes them more efficient, right? It decreases your costs or it increases your revenue in some way. So one of the ways we can kind of examine this is through this machine cost calculations, right? The way of determining how much does it cost me to run a piece of equipment, right? And so typically what we do is break these into two type of costs. So there's ownership, which is kind of your fixed costs, and then operating, which are your variable costs. We can typically break these down into a cost per hour or per acre basis. And these were kind of developed by ag engineers and ag economists. They have these ASABE standards that kind of break down how these are calculated. And I'm going to get into the full calculations, but just kind of give an overview of what we can do with this. And so why this is important is, typically farm equipment is your second largest investment after land. So it can be a pretty high cost. And so buying equipment can further increase those costs. And one of the hard things is really kind of complex to determine what is my cost of my equipment, how much is it costing, my herd or my cattle operation. And another thing that these are kind of important for is for custom rates, right? Kind of sets a baseline for, all right, this is what it costs me to, run a baler, run a cutter, rake, whatever it is. And then you can use that for custom rates. And there's a lot of tools out there. We have one on our website, our Ag Econ website, that it's like an Excel tool that helps calculate these things. But just to show kind of an example, we collect a lot of information on machine costs, and so I went back and I looked at price of the tractor in 2015 and compared it to what it costs now. So 2015, this tractor is about $35,000. A new one, if you went out and bought one now, it's about $60,100 from in our budgets. So just looking at the different costs between these two tractors, right? Because it costs more, it's going to cost more in ownership costs, those fixed costs. We have higher interest rates than we did 10 years ago, pretty significantly higher interest rates. So that adds into that. On the operating side, I mean, labor has increased, all these different things have increased, so it's going to cost a little bit more per hour to run it. Repairs, all those different things are also in these machine costs. And so this is just, there's a lot of these variables that are going to kind of affect this, how many hours you're using it, what size of herd. And so this is just kind of a rough, a baseline just to look at some things. And really what's important is looking at the difference in, the cost per hour. A new tractor is going to cost you about $11.78 per hour to run. Right. So you have a herd of 50. That cost ended up being about $94 per cow more per year. And so kind of the idea that I wanted to get off from this is that this new tractor increases your cost of production, right? You have an additional cost because it's more expensive. It costs you more. If we had a higher herd size, that's going to bring some of those costs per down based from economies of scale. But smaller herd size, this can add some significant costs to the operation. All right, and so that's kind of the idea that I wanted to get across is that this new equipment, it will increase costs. That break-even price now is higher, right? Because your costs are higher, you now need a higher price going forward to be profitable. And so if prices do come down, that's going to be an issue, is that you're going to get squeezed quicker than somebody who hadn't bought that piece of equipment, right? So there's more risk involved. But there are other ways, you can buy equipment that actually decreases your costs, right? So I grew up on a cattle farm in Nebraska, and we used to, cut hay a lot. We had a really old hay cutter that essentially would plug all the time. You can only do about half a swath. We bought a new one. It was a lot more efficient, right? We were able to do a full swath. You could cut a lot faster. And so this is kind of showing an example. If you go out and you buy something, this is a new rotary mower. It's a larger size. You're able to go faster. So the field capacity is essentially how many acres can you do per hour. So in this case, this newer mower, it costs more, but because it's larger and can do more acres per hour, that total cost per acre actually decreases from $7.69 per acre to $6.02. So it actually saves you money. Even though it costs more, it decreases those costs of production. And so this is just to show, depending on what you're buying, right, it can either increase your costs or it can make you more efficient and decrease your cost per acre or cost per head, whatever it is. So again, buying equipment, you want to make sure that you're buying something that makes you more efficient, right? It takes less time to do an activity. Maybe you have an old piece of equipment that breaks down a lot. You want to replace it with something it's more reliable, because that can be added in there as well. I know you can buy equipment that reduces hay losses. Hay feeding, hay costs can be a pretty significant portion of cost for a cow operation. So anything that can reduce those hay losses, investing in that equipment or facilities can also, reduce your cost. But just making sure that we understand that if I buy something, it might make that break-even price higher. We don't want to get in a situation where we, increase it, and then when prices come down, we're in trouble. So essentially, don't set yourself up to fail when those prices eventually come down. And so kind of moving on, I know I'm going to go through this a little quickly, but another idea is improving your herd efficiency, right? It's another way that we can invest money back into the operation, that we can increase our profitability. So cull your less productive cows, right? So cows that are producing a lower value calf, it's a really good time that we can reinvest and get rid of those calves that are, cows that calve outside your desired calving window, doesn't match the rest of the herd. This is a good time to essentially get rid of those. Because our goal is to improve some of the uniformity in our herd. So our more uniform calves, typically we see, if they're uniform in weight or color, they're going to get a little bit higher sales price, is what some research has shown. Coal cows are also more valuable, right? They're going to be worth more now than they are when prices go down. So it's worth it to kind of maybe cull some of those less productive cows. The thing is, you can invest in artificial insemination. We can improve our herd efficiency that way. I know we're going to have a future webinar that goes into this in more detail, but it does kind of offers some numerous advantages to small producers and allows you to, essentially reinvest some of this money into increasing your genetics, right? So it allows you to access better genetics at a reduced cost compared to your natural service. Heavier weaning weights, better replacements, more uniformity in your herd. So again, it's investing, making your herd better when prices are high. That way, when prices come down, you still have those better genetics, right? And so if you make it, your calves are able to gain weight quicker. That still lasts even when prices are low. And so then the efficiency standpoint, you're more efficient, your feeding is more efficient. So that sort of decreases your cost of production in that way. And so again, this is just kind of an option that's available. We've done a bunch of examples on this. And again, I'll go into this more detail on that future webinar, but this is just one example, like a 25 head herd. In this case, if you're getting a 25 pounds on your steer weight and your heifer weight, you're getting a little bit higher on your pregnancy rate, about 5%. The changes from adopting AI can be $468 for that 25 head herd. So in this example, it's showing that there's some benefit. Now, there's a lot of assumptions in this that can affect whether or not it pays or not. But just to show that even in these smaller herd sizes, you can have some benefits from this technology. And then lastly, your farm financial health. I think it's always important to continually evaluate. I know a lot of producers don't like to do some of these. They think it's hard to do. Maybe it's boring, whatever it is. But understanding where you are financially, I think, is really important. And that's kind of, especially on the crop side that we're seeing now, is if you would have kind of done this 3 or 4 years ago, maybe we wouldn't be in some of these farmers wouldn't be in as bad a situation, just because they have an idea of where am I struggling, evaluating my business as things get worse. And so as I always talk about, any decision a farmer makes has some sort of financial component to it, whether you're buying equipment or on the forage side or whatever it is. There's some component to it that's going to impact some of your financial ratios. And understanding then how the bank evaluates your operation too, right? How are they saying, are you in a good situation or bad? And so any decision you want to know, how is it going to impact how the bank views my farm? So the last thing we want is, when prices go down is the farmers, to get in a bad financial situation where they lose some of the farm. And really, how does that impact then the long-term financial goals? What does that farmer want to accomplish? Do they want to grow their herd? And understanding, you have to know what is your budget, what does your financial statements look like now to then use that to accomplish those long-term financial goals. So again, high price environments, they allow us to reinvest in the business. And we really want to make sure that we're not setting up to fail when those prices fall. A lot of it is, how can I become more efficient? Because increased efficiency is going to help you when prices go down. And really understanding what your farm's financial situation is and how we can use investments to improve our situation. With that, I guess I can turn it over to Matthew real quick, and then he can kind of finish up on the forward side.
Yep, that sounds good. Sounds good. We'll go ahead and just keep rolling.
Bear with me because this is trying to figure out which screen it's going to try and share. Does that look good, Hannah? We got it?
Yes, looks good.
All right, good. I'd rather be lucky than good any day of the week. So appreciate it for this opportunity. My name is Matt Fischer, Matthew Fischer from Clemson University, and real excited to talk to you guys about this today. Really, I'm kind of treating this the same way I talk to some producers about these opportunities. It's a interesting conversation to have when they come to you and say, I got money I need to spend. What do I do with it? So I think that's kind of what Brian and I were tasked with doing. But typically I break it down, even and Brian talked about machinery, but I tend to focus, and machinery is definitely an interesting and important conversation to have. But I typically break it down. I'll talk with them about their forage, their fertility, and their facilities. And really that offers them flexibility and opportunities, especially given the current cattle market and the revenues producers are seeing. So we'll start off strictly with forages. Obviously, it's a base of cow-calf stocker operations. With the increased revenue and profits, cash that we are seeing on farms and farmer and producers are talking to us about. Really, the foundation that I want to talk to them about most times is, well, what's your grass look like? How strong of a stand do you have? How bad's your weed control? It's opportunity to put some money in chemical and chemistry to take care of that. And to Brian's point, and I agree 100%, it's all about efficiency. And that comes with increased production, increased quality of the forage. So, you can look at various species and cultivars that'll help you out. It's an opportunity, even though we're in good times on prices, to look at your forage plan and therefore, what you're growing, what they're growing on the ground, and ultimately grazing plans. I guess this is a little sales pitch. On the next upcoming webinars, we're going to talk about contract grazing. There'll be one on integrated crop and livestock grazing. So it's an opportunity to do some stuff both on the planning and actually on the farm, increasing efficiency from that standpoint. Really, let's talk serious about it for a minute. When we're talking about fertility and forages, we're talking about NP and K. This is some examples I give to producers. When we had a fertilizer spike back in 22, I think it was. I'm sure we're still putting nitrogen. I can speak for people I work with. There was still nitrogen going out, but phosphorus and potassium were getting cheated on that a little bit. So I'm going to run through a couple examples here on the next three slides that shows one, the cost of even if you have proper soil fertility management, and two, the cost that if producers had not maintained that fertility management, what it costs to get to that proper amount of P and K. Kind of little house cleaning on what we're about to go through. So the recommendations I'm using, you'll see, and we'll talk about, they're generic recommendations. They're based off the assumption of six pH of 6, and it's for each crop that we'll talk about. Component prices, I grabbed them off the USDA's Alabama report from last week, but we're just going to use urea, DAP, and potash. Everybody loves a good QR code. That QR code will actually take you to our technology group with Clemson. CUCAT has a really nice fertilizer calculator. You can plug in prices and components, and it'll kick you out based off of your recommendation some options on there, and you'll see the output on that. So yeah, urea 667 a ton, DAP, diammonium phosphate 978, and potash 545 a ton. So, like I said, we'll talk through 3 slides. I treated this. I mean, I've run it various scenarios on hay versus pasture, multiple different species of grasses and forages. But we're going to do, I specifically selected cool season perennials, warm season perennials, and then small grain option here. So that being said, low management, meaning, producer might have cheaped out on the P and K over a number of years. We don't know exactly where we're at on that. But regardless, the numbers I got recommended 100 pounds of nitrogen, 100 pounds of nitrogen, 80 on P and 80 on K. That's $171 an acre. To put that out, that's to get you up to this right-hand side of your screen on ground that's been managed fertility wise. That 125/40 for the NP and K, that's effectively maintenance applications. But the big red number there in the middle is what I really try and explain, and what I'm talking about when we have these extra profits, revenue, cash, whatever word we're going to use for it, coming on the farm, and we've been unable to pencil out fertility on our ground. It's fine, it happens, but you're gonna have to understand that it's going to cost you an extra $61 an acre to get back up to that. So I mean, you can multiply that over however many acres we're talking here, depending on the farm, and it can quickly jump up. So that's the example, like I said, for fescue orchard grass, cool season perennial. Much no different. Not going to talk too much about, but low management on Bermuda Bahia grass, 150, 80, 80 for NPK. For if it's been well maintained, you're $61 an acre to get from that low management to that maintenance level fertility, and then likewise small grains. It's the same story. The interesting point to note, because we're dealing with grasses, and most all the grasses I've run, the P and K obviously is what's been not mismanaged, but not been available or not been put out. You're going to say in the grasses, I've seen most times if you're on pasture or just a grass setting, that's going to cost you around $60 to $70 an acre increased cost to go from low management to get your fertility back up, and that'll pay long range. It'll pay in dividends. Facilities, like I said, fences, permanent or temporary. If you look at across the university's budgets, fences are depreciable. They have a lifespan. I understand that sometimes just patching them works, but at the end of the day, with these increased revenues, it's an opportunity to try and upgrade your fencing ability. Working facilities, I'm very spoiled in and where I run cows. I've got a shed that my squeeze chutes under. I'm not getting rained on, so it's kind of a comfort level thing there, as well as maintaining the quality of your equipment underneath that shed. Water improvements, the ball waters that are out there, if you got an open trough water, you can improve some of your headache factor there with some of this money that you're seeing. High traffic damage, pasture damage, installation you see in the picture here to the right, kind of a high traffic feeding area. You can pay off for mud management, things like that, make your life a lot easier. Brian touched on hay and feed storage. I think that's a pretty important place to put some of this revenue or cash towards. And this is just kind of an example here I give. So you can see on the left-hand side, what model of storage you have for round bales. You see the kind of estimated losses based off of that method of storage. So I'm just going to pick the first column at $100 a ton because it's easy math for me to do. But you're looking at $100. So, on the ground, no cover, twine wrap bale. If you take that, potential loss due to storage, multiply it out, obviously. So $37 a ton worth of value can be lost in that just being stored outside. You can go down and look at this. I'll be happy to, I think, Hannah, we're going to share these presentations, or I'll be happy to share this with anybody. But you go down and you look at barn stored hay, 6% loss. I mean, well, that's easy math. But it's $6 a ton loss. So, we're going to say a barn's life expectancy is 20 to 25 years. We've all seen barns that are much older than that we wonder how they're still standing. But you can take that over 20 years, you're basically $31 per ton in savings on that barn stored hay. So I don't think I'm talking like the Micro Machine Man, but I'm about to wrap up here in a second. The takeaways that I've got, and I talk to fellow agents, I talk to producers, dollars invested today that you see coming on the farm, and you put into infrastructure, fences, facility upgrades, hay storage, whatnot. They're gonna ultimately pay off in the future. And like I said, there are less busted knuckles and less midnight calls. You take the opportunity in good markets to make it tough markets easier. Brian did a great point of production efficiency, and I'm not throwing off on new paint at all. It comes down to how Brian presented and said, if you can make it pencil out, sure. But at the end of the day, there's opportunity for increased efficiency in your cattle herd itself, average age, genetics, things like that. Obviously, production efficiency in your grass, good fertility, weed control, things of that nature. Lastly, I think Brian and I both successfully skirted around this question on what to do with this money when it comes to debt and taxes. It's the only thing we can't stop getting questions on. I mean, it depends. I've heard stories of in good cattle markets, people using these dollars to pay down debt, realizing that come January, Uncle Sam just decided to they just traded debt to Uncle Sam at the end of the day. So that's one of those definitely call on experts and professionals. So with that being said, there's my contact info. If y'all have any questions, feel free to reach out. Like Kenny said, that's my email, that's my phone number. I am available for questions. If I don't know it, I'll pass it to my limo driver.
Perfect. Thank you, Matt, and thank you, Brian. Those are both great presentations, super helpful. If you have any questions for any of our speakers, feel free to unmute or throw it in the chat. Either way, and like I said, all of these presentations will be uploaded to a link along with their recordings, and I will share those with everyone either this week or next week. So. And if y'all, as the speakers, want to add anything, just some last thoughts, please feel free to do that as well. I told y'all they were a quiet group.
I'll add one thing. In fact, James and I were talking about this afternoon. I mentioned that one of the more common questions I've gotten, really going back to early part of the summer, is someone that had done something, in my case, typically LRP, to cover downside price risk on cattle. And the market had really moved beyond that. And basically their question was, can I do something to protect where I'm at now? There's kind of two answers. If it's a small operator that is too small to utilize futures and options, then the truth is there's really not anything they can do because you can't have two LRP contracts on the same bunch of cattle. In other words, I couldn't just simply buy a higher level LRP. But if it's someone that you work with that is large enough to use futures and options, their strategy absolutely that they could use, they could just, kind of say, okay, the LRP is behind me now. It served me well. I don't need it now. And then just grab a put option. When LRP first came out, you couldn't do that. Now you can. So I could essentially grab a put option to reestablish a higher price floor. And then there's some more creative things you could do, like a synthetic put where you sell the board, mine out of the money call. But bottom line is you can't do anything through LRP, but you could utilize something through the futures market or even a forward contract for that matter to kind of reestablish a higher price floor, price guarantee. So and last thing I'll say, it's kind of a good problem to have, right? If the markets jump $30 since you bought LRP, it's kind of a good problem to have. So I'll also say that.
Am I muted? Yeah, okay. We might just end a few minutes early then if there are no other questions. Like I said, feel free to reach out to any one of us if you do think of questions later on. These recordings will be out there for y'all to access, along with any presentations that the speakers are willing to share with me. I'll get those uploaded. Yeah, so thank y'all very much, Brian, Matt, Kenny, and James for hopping on and taking the time to do this. I think it was really good.
Thank you for organizing these, Hannah. They've been a huge help so far.
Oh
Thanks
yeah,
so
no
much.
problem. It's been fun. And we're just now halfway through, so I guess I'll end by saying next week we'll have session 4 where we are going to talk about operation resiliency and contract grazing. And the last 3 sessions of this series are going to be more on the management side of things during this cattle cycle. So we hope to see y'all there. And I was going to put a survey in the chat, but I'm having trouble with it getting to pull up. So just be looking for that email with the survey if y'all will take the time to take that. And with that, I'll end the recording, and I hope everyone has a good rest of their day and their week. Bye, y'all.